I'm going to go ahead and start this off with basically presenting probably one of the stronger quarters we've seen in a while. It's the sixth consecutive quarter of plus side returns, and certainly I think if you would have asked us at the beginning of the year, what the fourth quarter and end of the year was going to look like, I don't think a lot of people would have painted it with as strong of a return that we saw. And so we'll go ahead and start there with just the review. Now this is a very busy slide, and I have it up there. I'm just going to go over the high points. Again, basically, we're looking at 3 consecutive months of plus side performance. Very strong. One of the bigger stories that I think we look through in each and every place that we're looking here is the Fed was involved in just about every story. So if we look at October as being a pretty strong month, it was a strong month because people actually had disappointing non-farm payroll reports to go through. Disappointing existing home sales and retail sales, and of course the 16-day partial shutdown, that shackled the Fed. So in each story for every month, the Fed really had a play in it. So people said, oh, good news is bad news and bad news is good news, so the markets will rally, and they did a very good job of actually pushing the 500. I see I got a little typo in there, to record highs during the month. And one of the things that we're going to see is that a couple of themes come out. Basically, thematically, we were looking at kind of growth-oriented issues, so health, biotechnology, particularly global health and biotechnology, and also tech forms and telecommunications did very well in each of the months that we're looking at. And if you take a look on the right-hand side of the laggards, we basically saw commodity funds taking it on the chin for the whole period of time. One of the other things, other than record closes, is that we saw that basically when we're taking a look at the total return as a percent of assets, 96% in October, 84% in November, and 91% of all equity mixed asset funds were in the black. So very strong performance. And one of the things that we did note in October, and I think it was a carry through, is there was really strong earnings reports by Amazon, Microsoft, Pfizer, IBM, and this certainly was that tech slash biotechnology type of plays that I think pushed the market up. And again, we had taper concerns on every single month, including December. If you remember the first two weeks of December, actually we saw our first down slide in performance. We had 8-week consecutive returns, and then all of a sudden for 2 weeks, as people were worried about tapering concern, we actually saw we saw negative returns come around. But I think what happened during the quarter is that the Fed did a much better job of announcing and telling us basically what was going on and why they would go ahead and take away that punch bowl. And they did so because the economy was improving. So I think by the time Janet Yellen got up during her testimony and basically was saying, listen, we have some more room to grow. We're going to keep interest rates low for the foreseeable future, but we are needing to take away some of the easy money. People actually started to understand, and I think that was one of the big things that changed in the last couple of weeks, and that's why we saw such strong returns. Again, science and technology up 5%, telecommunications up 4.47%, and of course gold taking it on the chin as well. So let's move on to the basically the quarter returns and the review of the quarter as a whole. And I keep wanting to use the word bipolar behavior because, again, good news was bad news and good news good news. But we started to get investors to start understanding what was actually going on, and they pushed this after after we had the Fed come out and do its announcements that it certainly was going to go ahead and taper. We certainly had a strong market rally, actually, and some people attribute it to a Santa Claus rally. But for the quarter, we saw 85 of the 95 equity classifications actually post plus side performance, and it's again the 6th consecutive quarter that we've seen this. At the top was USDE; they were the top dog, basically taking 8.76%, and at the bottom we saw sector equities taking it on the chin again, primarily being dragged down by the commodities funds. And as we can see, gold, AU is really our gold or precious metal equity funds now. It's basically the gold miners down 13.9%. Dedicated short biases taking a 1-2 punch. They have been losing, I think it's like 6 consecutive quarters in a row. 12.36% down for this quarter. And then we have the commodities, precious metals also getting a 1-2 punch, down 7.98%. But at the top, as as we'd expect, the equity leverage, DL, diversified leverage is the old tag, 14.23%. India region funds actually were a whole different story. People were actually taking a look at some changes in the banking regulation and also the rupee gaining back a little strength, and so we saw a huge rally, and we saw that on a month-by-month basis in the previous slide as well. So up 13.66. Unfortunately, this group is actually in the doghouse for the year. And of course, then we're taking a look at the global health, 11.50. If we take a look at the dollar lost against the euro and the pound, but gained against the yen. And really, this was the yen sliding against everybody, right? And certainly, Abenomics are to account here. And I think good things happened. Bad quarter for Japan. It was up only 2.5% or something like that. But certainly for the year, it's been spectacular. Where we see the real crush. Gold lost 9.39%. Oil declined 3.82% for the quarter. And if we take a look at the year, this is kind of one of the big numbers. Really, we're seeing some phenomenal numbers, up 25.26%. It's the best since 2009 that we're actually taking a look as far as returns go. And one of the things that we want to point out is the Dow actually achieved 26.5% return and 52 consecutive records being set throughout the year. So it was kind of amazing as well. And of course, we have NASDAQ producing some of its highest returns since 2000, coming in with a sleek 38.32%. So really a very strong return on good economics. And who would have thought this? At beginning of the year, people were talking about the fiscal cliff. They were talking about sequester having problems. We were talking about now government shutdown this quarter, geopolitical uncertainties, Fed tapering, and Obamacare. And we were able to put together some very, very strong returns. So let's go ahead and take a look at the United States Diversified Equity Funds as a whole. Basically, they rank number one for both the quarter and for December as well. For the quarter, turning 8.76% return, and at the top, as we'd expect, the equity leveraged folks up 14.23%, and the active extension funds, the alternative active extension funds up 11.14. That's ELCC. We had a little change in our naming convention a couple of months back. So you have those. Obviously, dedicated short bias is at the bottom. And if we take a look, basically, we are up, and it's the strongest return since 2003 for this group for the year. Up basically 32 point, actually that is not right, up 33.78. Can you ignore that 32.30? It's actually up 33.78%. So it's something I didn't change earlier. But one of the themes that we see that came out, and I talked about it just a little bit earlier, is large and growth came in favor, and not necessarily what we've done in the past, taking a look at small caps and mid caps, which was thematically the better plays in prior quarters. So this was kind of a change, and it certainly shows through with yearly returns as well. Let's go ahead and take a look at our big slide presentation. Basically what I'm doing is taking a look at the there you go. I'm taking a look at who the big players for, and again, large caps, S&P 500, alternative active extension funds, and equity leverage funds, all at the bottom. And then if you look at the bottom, at the top, and if you look at the bottom, we have small and mid caps at the bottom, along with dedicated short biases and some of the alternative funds groups. But basically, this was a large cap quarter, and both growth and value actually did well. And we'll see here in a couple of slides that we really weren't a big the valuation really wasn't a big factor. It really was the capitalization. So let's go ahead and move on to those slides real quick, and taking a look at the 4x3 matrix that we have for the quarter, we see large cap funds up 10.15%, basically just outpacing 2 percentage points small cap funds. So certainly that was a story. Now, one of the things I said is that we saw growth take a rally, but we saw value-oriented funds up 9.49%. But really, the difference between 9.31 and 9.49, which is the spread from core to value and growth, wasn't that big of an issue. Really, when we drilled down to see who was the winners, what was the biggest thing, we took a look at large cap growth funds, which was the high performer, up about 10.6%. 0.73%. And we saw that information technology, by digging into the active indices, by the way, we saw information technology, consumer discretionary, and healthcare, particularly biotechnology funds, were the contributing factors to very strong performance, and the top performing for the large cap growth fund is there. Right, so let's go ahead and move on to for the month view. And the monthly view, basically we saw a little bit of difference. Here is where we get back into maybe a little smaller play, but mid caps for the first month in 11. Mid caps were the top performer, turning up 2.98%, and that's kind of a big rise. And then when we take a look at the growth-oriented funds, basically that's where up 2.97%, and growth up 2.98%. That basically was the big change. If we took a look at the big winner, it was mid cap growth. They were up 3.18%. And one of the things I can say again is that basically information technology sectors and consumer discretionary industrial sectors were the leading candidates in there as far as the returns. Information technology added about 1.63% of portfolio returns, while consumer discretionary and industrial sectors added about 0.44 and 0.41%. So those were the kind of the big players. And growth-oriented funds actually made it to the top for the first month in 3. As we take a look at sector funds, we've kind of gone through some of the ideas here, but basically it was the third best. It contained the third best performer, the global health, and again this is a technology play, a global health biotechnology play. But global health was up 11.50%. But what really dragged down on the sector equity funds was they had 8 of the 10 worst performing classification in this group, and a good majority of them were commodities. You'll see that when I bring up the big slide showing now all the performance as well. As we take a look, the concern for commodity prices really played through the kind of the whole theme for the quarter, and certainly continued on through December. Second best performing group, so things got a little bit better. Science and technology, telecom plays were at the top. And one of the reasons we're seeing this is investors continued to eye merger and acquisition activity for telecom and cable companies. So it wasn't surprising to see, really science and technology up 5%, telecommunication funds up 4.47, global science and tech up 4.40 at the top of the leaderboard in December. And interesting, they were up 13.18% for the year return. However, it's the worst one-year ranking, so we just ranked them, the 4 groups. So worst one-year ranking for sector equity funds since 1994. So certainly commodities played a heavy role here, and we'll show you here in just a second how that panned out. So really at the bottom we have 2 distinct players for the second quarter in a row. Commodities and dividend payers took it on the chin, while more growthy and maybe you might even call them a little bit out of favor, although global health and health biotechnology have been in favor for quite some time, but financial services, science and tech, telecommunication, all doing very smartly this quarter. So we get to world equity funds, and world equity funds posted the second strongest return of the group. Really, this was very similar to last quarter, a developed international market play. So we see at the top, other than India region funds, which again, have had some changes in their banking structure, and really were the pariah, for the whole year, with exception for the the last quarter. But we saw European region funds at the top, 8.31%, and the global multi-cap growth funds up 8.04%. So really, this was that kind of global play, and we did see Japan, although I told you very good, for the year. Japan did cool its jets a little bit, along with the Pacific region. Basically, the laggards of this group, Pacific regions, only adding 0.68% to their last quarter returns, and Japan only adding 2.07% for the quarter. But again, up for the year, big numbers. You kind of saw a continuation of what I was talking about earlier. In December, no big changes. People actually shunning the emerging market plays, Latin America, China region, emerging markets, kind of all in kind of the bottom portion of fund returns. And if we take a look at the 1-year return, it was only up 16.82%. And of course, compared to the domestic markets, that was quite a change of pace. So if we take a look at the 3x3 matrices that come out here, we see a little bit of a change. And one of the things that I want to point out is higher returns in the bottom model, and that's global diversified equity funds. Certainly the inclusion of U.S. Focused funds in that kind of global setup, not just international, played well. So we're looking at favoring U.S. inclusion at this time, and of course the European market was that play. So this is some of the things that we've seen with this group as well. And the valuation changes a bit. So we go to international and small and mid. We're up 6.27, best performing group. And if we look at valuation, it was the value that was up for the international market. And if we look at the global, it really was more in line with what the U.S. did, large cap and kind of growth focus, 7.9% for growth-oriented funds on the global diversified 3x3 matrix. So let's go ahead and move on to the final slide for the world equity funds. And basically, this is showing us that it was truly domestic, global, international, well-developed marketplace. So we're seeing at the top European region funds, global multi-cap, global large cap, and then towards the middle we're actually seeing, and towards the bottom, the international, and as I was saying, kind of the emerging market areas, with the exception of Japan, at the bottom of the of the group. So let's go ahead and move on to our next piece, and basically that is I'm going to go back one more slide there, Jeff. Basically, it's our talk about the mixed asset funds, and I always like to include these. People want to see that, in fact, they had plus side returns for a quarter after having disappointing pieces, but I just wanted to point out it's up for the year 13.22%, despite having interest rate concerns. So I think that was an accomplishment that they wanted to achieve. In December, we did have the positive impact on yields, with the Fed actually saying they're going to remove the punch bowl. And so, but we still saw on average December was up 1.13%, and for the quarter, a really good quarter, 4.57%. I think a lot of people would have expected that type of return. If we take a look at the breakouts, though, mixed asset funds, 2055 plus funds were up 7.32%. Alternative global macro funds were at the bottom, up 1.27%. But one point I wanted to bring out is investors are still packing money away into this group. On a breakout, USD funds took in about $50 billion. This is through November 30th, year to date. Sector equity funds took in $26.8 billion. World equity funds took in $122.2. Mixed asset funds, by far the largest as far as net inflow attractors, year to date, 176.8, and alternative funds only took in 10.23 billion so far year to date. So certainly the story tells us that people are still turning their attentions toward the set 'em forget 'em mixed asset funds, and it's certainly a popular asset class for us. What's ahead? Well, I'll tell you, I could go through each and every one of these things, and we all know that earnings guidance is coming up. I think most people are expecting, because there was kind of lowered expectations, that we will probably do fairly smartly. But some of the concerns I have is ISM manufacturing numbers were actually a little bit lower. Both are considered in expansionary phase. One of the concerns that's hovering over us is this very, very slow recovery. Our friends at First Trust basically are calling it a plow horse economy, where it's just kind of steady and plowing ahead. But certainly it's one of our slowest recoveries in the post-World War II era. And that has concerns because, obviously the markets have been doing very well, but it doesn't seem that employers are hiring at the rate that a lot of people expect them to be hiring, although we've heard some good news with that as well. Housing markets on a slowdown, but the numbers are still beating expectations. I think what the bottom line here is, with the taper announcement, some of the uncertainties off the table. We just had the budget deal that the government passed. Wow, amazing that the government can actually pass a deal. They can actually talk to both sides of the aisles. This is an amazing thing, so that's a good thing. But when we take a look at rising interest rates just around the corner in January, probably get an effect once we start pulling some of that punch punch bowl way. Certainly, Jeff will talk about what it's done to mortgage backs and probably to treasuries here recently. But it seems that equities still are the only game in town. And even though we're long in this rally, so long in the tooth, and we could certainly have a pullback, I think for 2014 we'll have moderate returns, and like I said, some volatility in there, and lower than we've had this year. But certainly, absent some black swan event, this is certainly, like I said, the only game in town. Well, that's it for me. I'm going to go ahead and hand this off to Jeff, and he'll continue on with the fixed income portion.